Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, we're going to be doing the second installment of the What's on My Watch List series. And we're going to be taking a break from all the doom and gloom that's been out there in the financial media lately about the imminent collapse of the financial system and how banks are failing and interest rates are going up. We're going to take a break from that. And we're going to be looking at a company that I actually think might do pretty well in the coming years. And this is all part of a series where I take you guys behind the scenes and what companies I'm personally looking at and kind of just explain my thought process on how I initially discovered them, why I'm actually interested in them, and also what I think they're worth in terms of valuation. So, what price I'm looking to invest in them at essentially. And we're going to be looking at a company that personally I'm very heavily considering investing in, which for me, it's a big deal because my personal investing style is I really only like to buy one, maybe two new companies each year. I much prefer to, take the time to do my research on companies that I feel I'm able to understand, get a good idea of what I think they're worth, and then invest in them at that price. And to give you an idea of this, I can pull up my watch list here, and this is basically a couple companies that I've either done that on or am in the process of doing that on. So all these companies I'm at least a little interested in for whatever reason. Some of these companies I've talked about, some of these companies I'm invested in them. Some of these companies, I'm just kind of starting to get to know them a little bit. And I'm not someone who likes to, trade in and out of companies constantly. Again, I much prefer to just create a watch list, determine what price I'd be comfortable investing in that company at, and then if they are at that price, then great, I can invest in them. If not, I'll just wait until they get to that price. So, one company that's been intriguing me a lot lately is Sleep Country. So, I actually did a video on them a while ago, and overall, it was an okay video, but there were definitely some key points that I didn't address in that video that I want to cover in this one. And this company initially came to my attention through a script that I actually run pretty regularly on my website here, which, by the way, if you're new to my channel, this website I'm using is called tickernomics.com. It's a free to use website that I created to help retail investors analyze companies. So if you want to check it out, I will leave a link in the description. But basically, one of these scripts that I created is the Fama French factor model stocks. So this basically generates a list of companies in conjunction with the Fama French five factor model, which the five factors include things like size. So smaller companies tend to do better than larger companies. So it screens for smaller companies. Value is another one. So stocks with a lower price to book ratio tend to do better over long periods of time than companies with a higher price to book ratio. There's operating profitability, conservative reinvestment, and then also the market factor, which basically just looks at the beta and states that companies with higher betas, so generally more risky, if you're taking on more risk, you have higher expected returns. So I just ran this script, and if I click the insight tables here, Sleep Country actually appears on this list. So I'll sort this by market cap. We can see the error right here. Sleep Country, a pretty small company, about 573 billion USD. So that's how I initially came to find this company. Is it already had a list of qualities that I already know I'm interested in, and it was appearing on this list a lot. And it is kind of one company that I feel is pretty easy to understand, right? When you think of Sleep Country, pretty much everyone knows what this company is. I mean, they're just a mattress retailer. It's really not a difficult business to understand, especially because they're consumer facing. They don't have all these complex business to business relationships that you need to understand. And recently, their price has come down quite a bit, as has a lot of companies, as the fear around the whole bank failures has been kicking in. So potentially, this is a good opportunity to scoop up shares of a decent business that you want to hold to the long term. Okay, so let's start this whole analysis firstly by looking at just some basic valuation metrics so we can get an idea of what this company has looked like in the past. We'll look at the price to earnings ratio. Let's just go back 1 year and we can see it has come down quite significantly. Currently, the price to earnings ratio is only 7, and within the last year, it's been as high as we can see here, nearly double that at 12. And if we go back even further, we can see it was actually more than double that, not about 18 months ago. So clearly, there is some pessimism baked into this company's current price. Now, what I also want to look at is return on invested capital. So this is one of my favorite barometers to use when I'm assessing a company. And you can kind of use this as a general barometer for business quality. Companies that have higher returns on capital are probably higher quality businesses because they're able to earn high returns on the capital they have invested in the business, which ideally, if you can keep that going for a long periods of time, you're going to be able to generate quite a lot of shareholder value. And you can see it's fluctuated a lot, and this is in percent here, but it's been pretty consistently above 30%, which anything consistently above 30%, that's kind of the sweet spot. 30% is, at least from what I've seen so far, is pretty good. Obviously, this is going to change a little bit depending on the industry. You wouldn't look at this metric if you're trying to assess a bank or an insurance company, but for a retailing company, it's a really good metric to look at, because if you can think of it, say Sleep Country was to open up a new store, what type of returns would they get on the invested capital in opening up that new location, right? And obviously, the higher that is, the better the company's going to be. And you can look at this over time to see, is return on invested capital going down, meaning are they less competitive in their industry? So that's one thing. Now, another, if we look at the financial statements, and what I want to do is look at revenue over time. So if we go to the income statement, and we can look at it quarterly, we're going to see quite a lot of fluctuation here. And if we go back kind of into 2020, some of the quarters that they had in 2020 were pretty bad, to be honest. And that's really because they were forced to shut down. We can see in Q2 2020, they dipped below 100 million for the quarter, which for them is extremely low. But they have been able to recover. And even in some quarters, so as we can see here in 2021, the year over year is very strong because they had very poor 2020. So year over year into 2021, they had blowout revenue growth numbers. So this is a business where it's a little interesting because they haven't really been operating in a normal state for very long. And the reason I say that is because a key development that happened in the mattress industry kind of towards the end of 2017 was Sears went bankrupt. Now, Sears was another major competitor in this whole space. And what caused a result of that was a lot of the sales that would have been earned by Sears ended up going to Sleep Country. So I do think that from kind of 2017 into 2018, if we look at the yearly view there, a lot of this boost in revenue that we're seeing, for example, the 12% year over year growth in 2017, 5% growth into 2018, and then 14% growth. So we can see like it's been pretty consistently, except for a few blips here, it's been double digit revenue growth. And I think the reason why we're seeing that in this time period here, 2017 to 2019, was because a lot of the sales that would have gone to Sears ended up going to Sleep Country. And then, 2020 happens and they're forced to shut down, right? And then 2021 is kind of where a lot of the sales are catching up that would have occurred in 2020. And then 2022 is kind of an interesting year because you're dealing with, rising interest rates and economic instability and a lot of uncertainty. So it's a kind of a difficult business to assess, what is their steady state? And because there's been just so much going on in the industry. But what we do know about them is they are cheap. Currently, if you look at their valuation relative to their historical earnings, they are cheap. But obviously, they must be cheap for a reason, right? Pretty much every company is going to be cheap for a reason, whether it's valid or not. We have to understand what that reason is. So why I think this company is cheap, in my opinion, is for one, they sell consumer goods, right? And we're currently at a time where the general census is there's going to be a recession sometime in the year 2023, possibly even into 2024. So a consumer goods company would probably not do that well, especially one that sells big ticket items like mattresses. And what you're probably going to see, and what really the risk is people putting off purchases and sales might decline in the short term. Or something that's even worse is what Sleep Country calls trading down. And what that means is basically a customer that would have been purchased, say, a $1,500 mattress. Now, because of the recession and fears around that, that turns into a $1,000 purchase. So they purchase maybe cheaper or lower quality mattress. And now that customer is lost for 8 to 10 years, because that's pretty much what the average lifespan of a mattress is. So it's like $500 in lost revenue that you got, even if the customer is generally healthy, just because they are worried about inflation, the recession, whatever the case may be, they're going to trade down and try and save money as a result of that. And Sleep Country, they're also a store that primarily sells through retail outlets, right? And like I said before, we've recently seen a lot of high-profile retail stores go bankrupt, right? There was Sears, obviously, but then there's also Zellers. Toys R Us was another one that went bankrupt. And kind of as you're seeing e-commerce become more widespread, investors are, I think, less willing to take bets on retail companies. And so companies like Sleep Country are probably going to fall out of favor with investors. So because of those fears, we would expect to see valuation multiples decline, which I think explains the PE ratio that we've seen. Okay, so that covers the quantitative side of the business where we're looking at numbers and financial statements, valuation metrics. The next thing I want to do is look at the qualitative side of the business. So essentially, how can we verbally describe to someone why we think that Sleep Country would be a good long-term investment? And to do that, I put together some data in Excel here. So I went back in time and collected really three key data points that I think tell a pretty good story about this company. So one is total stores, and I've also summarized it in this chart here. So I collected this data going from Q2 2014 to Q4 2022, so the most recent quarter. And the blue lines here is how many stores they had open. And what we can see is that the number of stores was increasing pretty gradually until it got to around this point here, kind of midway through 2019, where it kind of stagnated. And we can see throughout 2020 and even to 2022, they did open some new stores, but it wasn't quite the rate that we saw before. And this is a major part of how Sleep Country will grow their revenues going forward, because you can think opening a new store is basically a new source of revenue for them, right? So that is obviously that's a key metric that you want to see going up. So I was curious to know, where's this going forward, right? Because that's what we care about, right? When we're investing in a company, we are buying a stake in their future earnings. And a key part of that is how many stores they're going to be able to open. So I did a bit of research and I was able to come up with a few key points here. So one thing that they had initially said before was that their goal was to open 8 to 12 new stores per year. Obviously, it's been a lot less now, as we can see, because of what happened in 2020 and then also the macroeconomic uncertainty that we're in right now. It's probably going to be a lot less than that goal going forward. But what's more important is store population density. So, as of a few years ago, really about 2 years ago, their store population density was about one location for every 134,000 of population. So the question is how low can that number get before the market gets oversaturated? And what they stated is that they believe one store for every 100,000 in population can be achievable without oversaturating the market. So that tells me that they do have the ability to open new stores. It's more just kind of permitting based on economic conditions and things like that. So I think for them, they are willing to open new stores and it's not going to oversaturate the market if we are taking their word for it and what they're saying here. The key question is, are they going to be able to raise the financing and able to do that? Because it is good, that's going to be more expensive now with interest rates going up. And are they going to be able to do that with the current uncertainty we're seeing, or are they going to be less willing to invest back in the business at that rate? I do think it's going to be less than what we've seen in the past. But based on this data, that does give us some confidence that they are going to be able to open more stores in the future. How many, we don't know, but probably less than they have been able to in the past. That's kind of a conservative assumption. And then just to compare it to something else, a US mattress retailer called Mattress Firm, they, as of 2020, had a density of 90,000 population. So Sleep Country is above that. So, like I said, I think there is some room for that number to go down a little bit. The next thing I was looking at was same store sales growth. And it's good to look at this trend over a long period of time. And like I said before, this was probably boosted by all the bankruptcies that we had been seeing in the retail space. And then this number got completely thrown out of whack, when the lockdowns happened in 2020. As we can see, it's represented by this orange line here. And the in 2021 the year over year was massive, and even in one quarter and in 2 quarters in 2020 they didn't even report in 2020 they didn't even report this number because it was just so ugly, and their stores were shut down anyway, so what's the point? But you can't help but notice before all of that happened, they were going down, right? We can see a pretty clear downward trend here from 2014 to 2018. And if we take 2022's, somewhat close to a normal operating state for them, it's currently even lower than that. And it does kind of align with this downward trend that we're seeing here. So what we can deduce from that is, same store sales, while they are growing, the rate at which they are growing is going down, which I think makes sense, right? Because they obviously can't keep, double digit growth going forever. And then the other key metric was sales that they're generating from online sources. So about a few years ago, a key risk that you would have assessed when you're looking at this company is the rise of Casper, right? And online retailing, the whole mattress in a box trend, and the direct consumer business model. Now, that has proven that it's not really viable, and Casper has even resulted to having a retail presence, which was kind of, the complete opposite of what you'd expect when that whole company started. But I think it kind of makes sense because when people are buying a mattress, they want to see it in person, they want to test it in person. But they aren't completely ignoring the e-commerce trend, and we can see pretty consistently around 20% of their revenue, except for some quarters where it was much higher than that. But from this quarter on, around 20% of their revenues derive from e-commerce, which would be two companies they acquired, Hush and Endy. Those are two major e-commerce retailers they have. So these are three numbers that I'm monitoring going forward. Like I said, if I had to try and make a prediction, I would say I would assume same-store sales growth continues to go down. Maybe it won't be negative like we're seeing here in 2022 once we get to a more normal economic state, whether that's next year or the year after that. Um, I would assume it would kind of continue with this trend line, but obviously, that's just, I don't know that for sure. And then regarding the total stores, I do think they can open more stores, but I don't think it will be the rate that we've seen in the past. And it's also likely that sales derived from online sources would increase in the future. But again, we all have to wait and see. So the next thing I want to do now is actually look at the valuation in terms of, what they're worth paying for on a per share basis. Okay, so for the valuation, I'm going to use the value of stock feature in my website here, Tickernomics, and this feature, it's designed to basically make doing a discounted cash flow analysis a little bit easier because they are rather complex to do, but this takes the math out of the equation and really just allows you to focus on entering your assumptions about, operating margin, revenue growth, etc., and to see what implications that has for the value of the stock. So I'll enter the ticker. That's the first step, which we just enter sleep country, and I'll slide this so we can do a 7-year analysis. And the only one of the assumptions here I'm going to change is revenue growth and operating margin. All these boxes here get pre-populated based on data that is 5-year averages. Now, obviously, you want to change some of these because you don't just want to take past averages and project them into the future. Because if investing was that easy, then computers would just take it over. You want to use some of your actual judgment, but some of these we can leave the same. Like, for example, the tax rate, we can pretty much assume this will be approximately equal to what it was in the past. Same thing really with capital expenditures and depreciation and amortization, because for this company in particular, these aren't that large numbers, so they don't impact the valuation that much. Working capital is another example. We can see this has been basically minimal in the past. So we'll leave all this stuff the same. And the one thing we'll change is revenue growth and operating margin, because these are the two most important things that influence the valuation of this company. And the terminal value multiple, I'll just leave that as 10, which is, looking historically for this company is more on the conservative side, which I try to be more conservative when I'm doing these assumptions. Now, the discount rate, this gets pre-populated based on the company's cost of capital. So this takes, the most current data on their interest cost, what the risk-free rate is to calculate the cost of equity. But if you don't want to use the cost of capital, some people want to use their own rate, such as 10, 12, 15%, then you can do that as well. You just change it directly. So I'll change that to 10%. Now, the revenue growth for the past 5 years, it's been just under 10%, 9.97%. I don't think it will be quite as high initially, but I do think they can still grow their revenue if they open some new stores. So conservatively, I'll just put 3% for revenue growth. And the operating margin has expanded, and they have mentioned that they are working on efforts to streamline the business. So in the most recent, or in the last 12 months, it's been just under 20% at 19.61. Again, I'll go a bit more conservative and put 18% for operating margin. So that applies for the whole 7 years. So I hit calculate DCF, and we go down here and we kind of get an idea saying that the intrinsic value, this is in USD, by the way. So all the numbers in the system in Tickernomics are in USD. So a Canadian stock like Sleep Country, it's getting converted into USD. So the price per share on a USD basis is 16.46. And with these assumptions, we get an intrinsic value of $28. So what I try to look for when I'm doing this is I want the intrinsic value to be at least twice that of the current price, because that gives me a margin of safety, right? You've probably heard the concept margin of safety before. We have to build in some, room for error, whether it's an error with our analysis, could be just due to luck as well. We want to make sure that we don't need to be 100% right about our assumptions in order for this investment to work out. So, how optimistic do we need to be about Sleep Country to get there? Right now, one thing I want to do before that is let's assume revenue growth is zero, right? So basically, they have the year they had last year, they repeat that for 7 years in the future, and then after 7 years, they're selling for about a 10 times terminal value multiple. So let's calculate the DCF there. You can see they're less undervalued now. The intrinsic value, $23, and again, the current price is 16, but still slightly undervalued even with these, rather doomsday assumptions, right? Because I think for a company like Sleep Country to have zero revenue growth for the next 7 years, that would be pretty bad. And I don't really see that happening. I think it could be higher. Let's say we put 5% revenue growth. What does that look like? Now, this is the range where it gets interesting, right? So basically, what I would deduce from this is in order for me to be comfortable with this investment and buy it at its current price, I need to be comfortable assuming that they can maintain an 18% operating margin, which does seem likely based on what the company has said and what the past tells us, and revenue growth of 5%. Now, this I think is the more difficult part, because if we open up the actual details with revenue growth of 5%, then we're saying by the year 2030, in US dollars, they'll have $951 million in revenue, which I guess that'd be around 1.3 billion Canadian. I think it's achievable, but based on what's going on in the world right now, really with the fears of the recession, how these are larger items and are probably going to suffer if there is a recession this year and the next year, then maybe they might face some blips in that. And obviously, the revenue growth isn't going to be consistent going forward. It's probably going to be, maybe slower in the near term, but maybe 3, 4 years down the road, hopefully, once these economic uncertainties have alleviated and they get back to normal business, maybe the business starts to do a lot better. So you can kind of see why I'm interested in this company. I haven't actually purchased any shares in the company just yet, but it is looking pretty good from what I can tell. So that pretty much does it for this video, guys. I hope you did find this insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate if you would consider subscribing. I'll see you guys in the next video.